When your employer makes contributions to your 401k plan, they are going in pre-tax. Now, the law changed not that long ago to allow employees to direct their employer to make, in some cases, Roth contributions as an employer into their plan. But from the employer's perspective, for years and years, it's always been pre-tax. That's because when the employer makes a contribution to you, it's kind of like them paying you a wage, right? That's an expense that they would deduct on their income statement, on their statement of operations. And when they make contributions to your retirement plan, it works the same way. They get a tax deduction from the employer's side. We're not going to talk about the complexities that may exist if you tell your employer to make a matching Roth contribution. That'll be a conversation for another day. But just know that in most cases, when you're making a contribution to your 401k, regardless if you're putting the money in pre-tax, what we call a traditional contribution, or if you're making a Roth contribution to your 401k plan, odds are your employer's matching contribution or profit sharing contribution is going in pre-tax. And when the day comes that you decide to take the money out, maybe you've been contributing a Roth your whole life into your 401k plan, you may be in for a little awakening, recognizing that your employer's contributions went in pre-tax. And when you distribute that out, that will be taxable as ordinary income to you in the year that you take a distribution from your 401k plan. There's a third type of contribution that you can make. We have the pre-tax one, we have the Roth, and then there's a third called after-tax. Now, not all 401k plans offer after-tax contributions. In fact, not all 401k plans offer Roth contributions. Everyone that I've seen offers a pre-tax or traditional contribution, which is where you reduce your taxable income today, kick that bucket down the road. And then when you're in retirement, hopefully you're in a lower income tax situation, either because your income's lower or because Congress has kept low tax rates, which I think will be the case for the next few years. I mean, I just took a little peek at the House bill that Congress has kind of leaked, maybe released different people about some of the proposed legislation that might be coming down the road, but don't hold your breath because the Senate has yet to share what their ideas are on upcoming changes to tax policy and law. But assuming tax law stays the same and tax rates stay the same, then your hope when you make a pre-tax contribution is that you're in a high income tax situation today, you'll be in a lower income tax situation in the future when you take the money out, and you're able to kind of play the game from a tax perspective. Alternatively, if you're a big fan of the Roth contribution, then your hope is that maybe taxes stay the same, maybe taxes go up, whatever the case may be. Your hope is to generate tax-free income and tax-free assets so that down the road, you don't have to worry about what tax legislation will be or what proposed changes may be coming down the road because those distributions coming out of your Roth form are tax-free. Now,